The housing market is crumbling. What was once one of the closest things to an infinite money glitch is now turning into one of the most distorted and broken markets in the global economy. Simply put, this is going to be one of the most significant economic shifts the modern world has ever seen. So in this video, we'll look at why the buyers are tapped out, why the sellers are losing pricing power, why the Fed may actually work against the market, and why this same property trade is buckling from London all the way to Auckland. My name is Nick, and this is the Finance Bureau. Unless you've been living under a rock, you'll have noticed that housing prices have been going absolutely insane over the past decade. And if you have been living under a rock, it might be a good idea to get it valued, as it's probably worth a lot more than you think. Anyway, as a result of that parabolic run, prices can stay stubbornly high while the market underneath actually weakens. Realtor.com's May data for the US showed national median list prices are down 2.4% year over year, the seventh straight annual decline and the steepest drop in records going back to 2017. Of course, this doesn't mean that every seller is panicking right now. In May, existing home sales actually rose. But the market, as far as price is concerned, is trending down, and it still looks fragile today, with affordability having the biggest impact. In May, prices fell in 28 of the 100 largest metro areas. But many argue that the real problem is the monthly payment. According to the latest data from Freddie Mac, at the time of making this video at least, the 30-year fixed mortgage is at around 6.5%. And that's down slightly from the 2023 levels, but still miles away from the easy money years we saw either side of COVID. And that, my friends, takes us to the recent price cuts. Now, a price cut is not a gift from a generous seller to the buyer, of course. Landlords and homeowners aren't exactly known for their generosity. If homeowners are lowering their asking price, they're only doing so because the market has forced their hand. In April alone, 35% of US home sellers cut their asking price. That's a clear signal that buyers are pushing back hard enough to force a significant repricing. And this is a clear pivot in the psychology of the whole market. A few years ago, sellers listed high because someone virtually always showed up to buy. Now, 65% of US households can't afford a median-priced new home, at least according to data from the National Association of Home Builders. That market has a massive wall of missing demand, and there's no shortage of data elsewhere to back that up. According to Realtor.com, asking prices have fallen or held flat for more than 31 straight weeks, with outright year-over-year declines for 20 straight weeks. It's also worth noting that the markets seeing the biggest drops in price were the ones running hottest prior to the shift. States like Texas and Florida were among the most likely to cut prices, which is no surprise, considering that this is where inventory and investor heat was the most intense. For years, the approach to making money in real estate was surprisingly simple. Buy a house, wait, refinance, repeat. Bob's your uncle, Fannie Mae's your aunt. But that concept is breaking down in a big way as the model stalls, and we're going to explore exactly why that's happening. But before we do that, if you want to stay ahead of the curve on market shifts like this and want to make sure you're prepared for whatever the future has in store, then you should sign up for the Finance Bureau newsletter. It's absolutely free, and we break down the key moves across markets, macro, politics, and more, so you don't miss what matters. All you have to do is click the link in the description or scan this QR code on the right of your screen to get started. Now, for about a decade before the Fed's last rate hiking cycle began in 2022, the housing market's unbelievably hot run was fueled by one main ingredient: cheap debt. The houses were getting more expensive, but the loan terms made it manageable. By January 2021, Freddie Mac said the 30-year fixed mortgage rate hit 2.65%, the lowest in the survey's history. And that rate did not just help buyers, of course. It helped existing owners turn their house into a financial goldmine. 2020 and 2021 refinances locked in historically low financing costs, lowered payments, and in some cases, pulled cash out. About 14 million homeowners refinanced during that pandemic-era boom. But Think about what that actually means. Millions of people got the best loan of their lives. Then the next generation stepped in to face a totally different market reality. The scale was enormous. According to Freddie Mac's data, there was an estimated $2.6 trillion in inflation-adjusted refinance originations in 2020, more than double the previous year. That means a vastly lower household cost and far more household breathing room. As a result of this, we then saw a lock-in effect develop over the following years. By late 2025, more than half of the US homeowners had mortgage rates at or below 4%. Selling meant giving up a cheap loan and replacing it with something much less favorable. So people stayed put. And that low-rate lock-in helped freeze supply, but it also inflated the sense that housing could not weaken. About a third of outstanding mortgage debt was refinanced during the low-rate period, giving millions of owners a deal that cannot easily be recreated. For them, moving now is essentially volunteering for a worse monthly bill. It also changed how people thought about their houses. When the value of their home equity rises while refinancing is easy, owners tend to view that equity as backup spending power. But that only works when the credit system keeps giving them another option. But builders don't have that emotional attachment. When demand slows, they can cut prices, offer upgrades, or buy down mortgage rates. And in May 2026, 32% of builders cut prices and 61% used sales incentives, according to data from the National Association of Home Builders. And that puts existing sellers in a pretty uncomfortable spot. One May 2026 survey showed the average builder price reduction rose to 6%, while those sales incentives had stayed above 60% for the 14th straight month. A normal homeowner cannot compete with that. And it seems that sentiment from the buyer side matches this. New homes can come with builder discounts and mortgage incentives, but existing sellers often need the sale price to fund the next home purchase, and that puts the resale market in a bit of a bind. So, builder confidence isn't exactly soaring. The home builder index remains in negative territory, with high mortgage rates and rising material costs weighing on the industry. Real estate brokerage Redfin said in its 2026 outlook that the year ahead would be a great housing reset, with affordability expected to improve slowly. But that was before the Iran war. So there might indeed be a housing reset, just not the one that Redfin had in mind. And at the very least, it's a very different story from automatic appreciation and up-only market. So when higher mortgage rates killed the refinance boom, recent buyers lost the easy path of waiting a year and resetting the loan lower. The market got used to relief arriving through cheaper borrowing costs. But the problem is that the Fed is not really supposed to be in the business of protecting the housing market. Its official job is maximum employment and inflation at 2% over the long run. Home prices being objectively too high or politically problematic is not really in the Fed's wheelhouse. And right now, the market is not just talking about fewer cuts. The Fed held rates steady after its latest meeting, but the message from new Fed Chair Kevin Warsh was notably hawkish. Warsh put price stability front and center. And the Fed's latest dot plot, basically each official's forecast for where rates are heading, showed 9 officials penciling in a hike this year. 2026 started out with expectations of rate cuts, but that story has changed drastically due to the Iran war. Buyers who were waiting for relief are now facing the reality that the cavalry may not in fact be on their way. And it's inflation that's playing the big part here. May CPI rose 4.2% year over year, the fastest pace in 3 years, driven, unsurprisingly, by energy pressures. And that's well above a comfortable inflation environment, even if you factor in the idea that the Fed is likely willing to have inflation a bit higher than the official 2% target. Fed officials have communicated pretty clearly why they're so worried about this. Minutes from the April meeting said several participants voiced concerns that years of above-target inflation could affect wage and price-setting behavior. Translation? They can't just wave this away. But bringing things back to housing, this is a bad setup for real estate. As we mentioned earlier, 30-year mortgage trackers are running at around 6.5%, with persistent inflation and firm labor market keeping pressure on the Fed. And that keeps things stuck at painful level. Now, it's important to point out that mortgage rates are not literally set by the Fed, of course. They move through treasury yields, inflation expectations, spreads, and lender pricing. But that's not to say that the Fed has no impact at all. Far from it. Traders watch expected Fed policy because it bleeds through the whole structure. And this leaves housing with bad choices. Expectations are now leaning more and more toward the Fed holding rates or possibly even raising them, while calls for cuts are fading as war-driven inflation hangs over the economy. No cuts means no clean affordability resets. Hikes would make the payment problem even worse. And that repricing hurts all the more because people were told to expect relief. Earlier this year, Fannie Mae's outlook had mortgage rates falling toward 5.7% by the fourth quarter. Obviously, those expectations are no more. And recent buyers are in the worst spot of all. They don't have the old 3% mortgage, and they don't have an obvious refinance window. If prices continue dipping while payments remain high, the strategy of just hold and refinance doesn't work. And the longer inflation stays above target, the harder it becomes to justify easy money. Inflation has remained above the Fed's 2% target since 2021 based on their preferred PCE measure. But the housing market, certainly the one that we've become accustomed to recently, was built for a friendlier rate world. And speaking of the world, America is not special here. This massive shift in property markets is global. UK house prices unexpectedly fell for a third straight month in May, with leading mortgage lender Halifax saying elevated borrowing costs and uncertainty continue to burden the market. While prices in the UK are falling month on month, the average price of a house remains around £300,000, which is about $400,000, all while buyers are getting squeezed by mortgage costs. So, a quick glance at house prices might indicate that the housing market looks strong, but transactions are becoming harder underneath. The Royal Institution of Chartered Surveyors showed that agents saw buyer inquiries, sales, and prices fall in May, while transactions were taking an average of 21.5 weeks to complete. There's a clear friction in the market, and the warning signs keep piling on top of each other. One recent Reuters poll said analysts had cut their 2026 house price forecast to 1.8%, with London expected to fall 0.3% this year because of borrowing costs. So there may be relatively less worry for the overall market, but in expensive markets like London, a small rate shift can hit demand hard. In mainland Europe, the pressure looks a little bit different as it has shown up in rents and politics, but it's no less serious. The European Commission's housing plan includes a ton of work on short-term rentals in stressed areas because tourism demand is colliding directly with local housing affordability. Rome is one such example. Ahead of the 2025 Holy Year, landlords shifted more homes into short-term rentals. Long-term rents rose sharply, and locals were pushed further out. The property market did exactly what paid owners best. Not exactly surprising, but now the EU is acting on short-term rental rules as part of an affordable housing push and is cracking down on the Airbnb economy. Countries like Spain have been moving harder. Late last year, the Spanish government issued a $75 million fine against Airbnb over unlicensed tourist rentals, part of a bigger fight over whether cities are for residents or just revenue streams for landlords. Europe's affordability strain has become so extreme that there are even reports of startups selling individual bedrooms in shared flats and developers helping friends buy together. The European Parliament says EU house prices rose 53% between 2015 and 2024, while rents rose about 28% from 2010 to early 2025. Now, this might all sound like prices are staying high and the infinity money glitch is working as intended. But when they're trying to sell the idea that buying a single bedroom is home ownership, there's a pretty clear signal that a market is completely tapped out of buyers. And that's a market that has been pushed to the extreme, and it's ready to roll over on the first sign of weakness. But what would that actually look like? Well, look no further than New Zealand. New Zealand is one of the clearest examples of a country that relied on property as a national wealth strategy, and they pushed that to the absolute limit. But after the market peaked in 2022, following an epic 25-year run, things turned ugly fast. Data from Cotality showed that house prices were about 31% lower in real terms from the peak, putting real prices back to levels not seen since 2016. And that has changed the whole New Zealand economy. The country had relied for decades on inflating housing to engineer recoveries, but that approach has failed this time. If property stops pulling the economy up, everything suffers greatly for having been dependent on it. Almost 20% of Auckland sellers lost money in the first quarter of 2026, and more than 40% of apartment sellers took a loss. That's a long way from the old system that property always bails you out. And needless to say, that's not exactly an infinite money glitch. But if New Zealand is a warning sign for what's to come for the rest of the world, how does this actually play out? Well, there likely isn't enough leverage in the system to see something like 2008 again. The more realistic danger is a long, grinding reset that damages buyers, sellers, local economies, and politics simultaneously. For a rough estimate on how far the current system has taken us, the OECD estimates real house prices are still over 40% higher than just a decade ago. And that's why younger people are so angry about this. 60% of OECD respondents aged between 18 to 39 worried about housing affordability, compared with 38% of those aged 55 to 64. Older owners got the asset boom. Younger buyers pay for the system that provided it. But even if prices do continue to drop, it might not be the way young people would hope. In the US, household debt reached $18.8 trillion in the first quarter of 2026, with mortgage balances at over $13 trillion. Housing stress is hitting the whole consumer economy, and that has a knock-on effect that can create a negative feedback loop. Foreclosures in the US are already flashing yellow. First quarter foreclosure filings neared 119,000, a 6-year high, driven by higher ownership costs and household debt pressures. And that's some major distress. The payment pressure in the US goes well beyond the mortgage, of course. Non-mortgage costs are taking a much bigger share of monthly housing bills, and many owners who thought they were safe are in for a rude awakening. Rising insurance premiums in particular have made it harder for some homeowners to keep up with mortgage payments, especially in high-risk states. When insurance jumps, the bank isn't going to lower your monthly principal. Property taxes are another hit. Insurance and taxes now cost more than the mortgages for some homeowners, meaning the idea of securing a cheap rate is only half the story. Cheap debt helps, but it's not even the main bill in some cases. Depending on the jurisdiction, policy can actually make the problem worse too. Tax-favored housing can lift prices and make buying harder for lower-income households, and that only amplifies the issue of inequality in the developed world that are reaching a breaking point. New Zealand's housing slump has cast serious doubt on property as a reliable investment strategy, with the effects of its downturn being a major drag on the country's economy. Now, why is that a problem for the rest of the developed world? Well, because most other developed countries also relied heavily on the property market during their economic booms. Buyers may get more negotiating power as property markets cool off, but that doesn't mean housing is about to get super cheap. For prices to drop considerably, there would need to be serious economic pain. And in that scenario, by definition, buyers won't have much buying power. So, no matter how you slice it, the easy money real estate era is over. The market model has been pushed to the brink. There's only so much you can squeeze out of buyers. But real estate markets take much longer to adjust when compared to something like the stock market. It may seem unlikely now, but plenty of countries will soon start seeing those housing prices move the way they have in New Zealand. The infinite money glitch was nice for those that got in on it, but it wasn't infinite after all. Alright, that's all we have time for today, but what do you think? Has the global property market been pushed to its limit, or is the market just in a little gully right now? Feel free to get highly opinionated in the comment section as always. And if you want to learn about how the stock market is in an equally delicate spot, then you can watch our video on that right over here. That's all from me today. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, signing off.